Hello and welcome back to Principles of Accounting 2. I'm your host, Dr. B. We've made it to the third week, which is fantastic. We're making really good progress. So in the third week, we got quite a few things going on this week. By now, you are all underway with your 10K projects. I've had the opportunity to check out your 10K conversations, which is fantastic. I think the class is making really good progress on the 10K projects. That, in my opinion, it's a fun way to explore companies that you're interested in, and gives you an opportunity to discuss those companies, and uh, it's interesting. I think it's fun because it gives you an opportunity to view a company in its natural environment. You're able to take a look at the financials to better understand the financials. And the idea behind it is that, especially in 221, it gives you an opportunity to understand how companies make decisions based off of the financials. And we'll explore those concepts as the weeks go forward. So before we get started, just a few housekeeping notes I want to discuss in the classroom. So going into the classroom and knowing that we're in week 3, couple of housekeeping notes. This week, you'll have the 10K balance sheet discussion. That's always fun, right? You'll have your homework assignment, which is similar to the last few. It'll be about 10 questions, true, false, multiple choice matching. Few different things this week, right? I mean, of course, you'll always have your weekly report out, which it's kind of nice because it gives you an understanding of what went well, what didn't, what you like to see change, and all that good stuff. Two other assignments for this week. So it's a busy week, right? We have the career exploration assignment. For those of you who have already taken 220, it is very similar, very, very similar to what you did in 220. The career exploration assignment gives you an opportunity to look at employment opportunities, to better understand the area that you're interested in, all that good stuff. And then you'll have what we call quiz 1 or exam 1. Exam 1. Exam 1 is like a long quiz, basically, except the difference is exam 1 covers everything you learned in weeks 1, 2, and 3. Exam 1, it's a little heavy on the grade side of things, on the grade, right? Exam 1, if I remember correctly, I think it's like 30 some odd questions. I think it's been a while since I've seen it. It is true, false, multiple choice matching. It covers everything you've learned from up until pretty much this week, right? It is worth, I want to say, like, not 20% of your grade, but it's up there. It's like at least 10%. Yeah. So take your time with it. Definitely take your time, open book, open note, all that good stuff, and do your best. Yeah. So that's the exam. It's due at the end of this week, along with everything else. So to recap, you have your 10K discussion on the balance sheet, your homework assignments, 10 questions, just like the ones before. You have your week 3 report, but the two new items for this week are the career exploration assignment. It's like a page and a half, 2 pages, whatever. And then you have your exam 1. The exam 1, it's worth quite a bit of your grade. So please start it early and take your time. Yeah, definitely take your time with it. Open book, open note, just like your homework assignments are. And it's very, very similar in nature to your homework assignments, but think of it like a really long homework assignment, right? But definitely take your time. It includes everything you've learned up until this point or toward the end of this week. So any questions on that? Hopefully it's straightforward, yes? Okay. Again, if you have any questions, just feel free to unmute your mic and ask your question. Okay, and hopefully these sessions are helpful for all of you. Okay, let's jump into it. This week, we get back into managerial concepts, managerial accounting, which you've pretty much already learned in week 1, and a little bit in week 2, but week 2 is more covering the statement of cash flows, which is a mix between managerial and financial. Britt, what's going on? Do you have a question? Go ahead and unmute yourself if you do.
Can you hear me now, Dr. B?
I can hear you now.
All right. Hi, Professor. I wrote down 3 things that I was wondering before you delve into week 3, if you can just briefly go over only 3 things from the end of chapter 2.
Yes. Yeah, we can do that. What are those 3 things?
Yes, sir. So I wrote it down. So it was just a gloss over for horizontal analysis, vertical analysis, and the common size statements. I was just reviewing my notes yesterday, and I was like, I just wanted you to gloss over it if you could.
Yeah, we can do that. Absolutely. Let me see if I can find that PowerPoint presentation, because I think that would actually be helpful. That would have been last week. Okay, yeah, we can do that real quick. So you said horizontal, vertical, and common size, right?
Yes, sir.
Okay, great. Okay, horizontal analysis. Okay, horizontal analysis, what is it? So we look horizontally across each line item on the balance sheet and income statements to understand the change between years, right? Or sometimes between months, it depends. But the purpose of it is to understand the dollar amount change and the percent change going across horizontally, right? That's the why they call it that. And so in this example, we're looking at the difference between 2016 and 2015. So to figure out the dollar amount change, you take the newer year minus the older year. So in this case, 2016 minus 2015 to get the dollar change. To get the percent change, you take the newer year minus the older year divided by the older year. In this case, think of order of operations. So imagine there's imaginary parentheses on that top part. So you do the subtraction first, and then divide by the older year, or you can simply take that difference and then divide by the older year. So, for example, current assets in this example, we have 550,000 for 2016. 2015, we had 533,000. That the difference between those 2 years is 17,000. It went up by 17,000. So what percentage change is that? Well, if you take 17,000 and divide by 533,000, we get 3.2%. So in other words, it's a 3.2% increase from the previous year. Does that make sense, Britt?
Makes perfect sense. Just wanted to make sure that I understood what was going on there.
Wonderful, absolutely. Okay, and so let's take a look at your second one. Is they had a question on was the vertical analysis.
Yes, sir.
Vertical analysis, we look at everything expressed as a percentage, and it's not year to year. It technically is year to year, but it's also a good way for a company to compare their performance to other companies. So looking at a vertical analysis for the balance sheet, we express everything as a percentage of total assets. On the balance sheet, it's a percentage of total assets. On the income statement, everything is expressed as a percentage of total revenue. And the reason why we do this is to understand how our assets, liabilities, and equities are allocated, what percentage of them what percentage of them are allocated through percentage. So looking at this example, we recognize that 48.3% of all of the company's assets are found in current assets for 2016. In comparison to 2015, 43% of all assets were allocated in current assets. So that tells us as a manager that, oh, we must have had an increase in cash or other current assets, right? And the reason for this is to better understand. The reason for this type of report is for us to better understand what percentage of our total assets are being utilized and for what. Britt, does that help you to better understand vertical analysis?
Yes, it does, Professor B.
Wonderful. And so that brings us to our next one, is common-sized financial statements. Common-sized financial statements helps the business to better understand how it is benchmarked against its competitors and the industry. How is the business performing in comparison to their competitors and the industry? And with this, we look at the income statement from a perspective of total revenue. It's very similar to the vertical analysis. We estimate everything as a percentage of total revenue for the income statement. On the balance sheet, it would be a percentage of total assets. And we compare our percentages to other companies within the industry, within the same industry, to understand how our business is performing in comparison to our competitors or to other companies in the industry. And that's common-sized statement analysis. Britt, does that help for that one as well?
Yes, sir.
Wonderful. Very good. Okay. Is there anything else I can help before we move on to the current week?
Okay, one more. I'm just going over my notes because I just remembered as I was studying. Current ratio. I went over that and kind of slipped my mind, was current ratio.
Yep. So the current ratio is going to be your current assets divided by current liabilities. Current assets divided by current liabilities. The reason why we compute that ratio is to understand if the business has the ability to satisfy all of its current liabilities. Can the business pay off its current debt, basically, is the way to think about that. Good question. Does that help to answer your question?
It does, but I had one further. After the formula, I think my question was on the application of it. So it was, once I get that value, how do I interpret that value to be able to satisfy the question? I hope I'm articulating that right.
Yep, you are. And to answer your question, for that ratio, 1 or higher means it's favorable, that the business has the ability to pay its current debt. And closer to 1, the better. Or
Okay.
more than 1, the better. Mm-hmm.
Okay, thank you.
My pleasure. Absolutely. Very good. Okay, so let's go ahead and move into week 3. I want to discuss the concept of job order costing. Job order costing. And then in week 4, we'll talk about other costs associated with business. Job order costing, we'll talk about this week. Next week, we'll talk about process order costing, and we'll talk about activity-based costing. Activity-based costing is a real interesting concept, but we'll talk about that next week. This week, we'll talk about job order costing. Okay, so let's jump into it. Job order costing. First, we need to understand why we cost things. It's important for the business to measure, record, and report all product costs. What is a product cost? And we talked about this on, I think it was week 1, maybe. We talked about product costs. what goes into a product cost? We have direct labor, direct materials, and factory overhead. Direct labor, direct materials, and factory overhead. These are all costs associated with the manufacturing of a product. Okay. Now, we take that information and we put it into our cost accounting system. The cost accounting system can then be used in either job order costing or process costing. With process costing, you want to think of a continuous process. In job orders, which is what we're going to talk about today, is we get a order from our customer. And our customer says, hey, you know what? I want to purchase 20 guitars from you, because we're a guitar manufacturer. Customer says, I want to purchase 20 guitars from you. And we say, great. So we look at that as a job. That order is a job, hence the name job order. And so we look at these things called job order cost sheets to better understand the total costs that go into completing that job. So that's job order cost. And we'll talk a little bit about process costing. Process costing, which is something that we're going to go a little bit deeper into next week. Process costing, I want you to think about a company that continually makes something without stopping, or that's not job-based. It's continuous. That's process. Process costing companies would be companies like an ice cream manufacturer, like Breyers, or, think of your favorite ice cream company, right? Hershey or whoever, right? They continually make ice cream. That's why you go to the grocery store, they always have ice cream, right? It's the grocery store didn't say, send me 100 units. It's continuous, right? There's no job involved there. It's just continuous. And so that's what process costing is. We'll talk more about that. Okay. Product costs include setting product prices, controlling operations, and developing financial statements. To set prices, we need to understand the cost associated with the development of a product. If I set the price of my product below the cost of manufacturing, I'm going to lose money, right? The idea of business is to not lose money. And so we use product cost information to set prices. We also use product cost information to control our operations. If I set up an assembly line in my factory to make guitars, I want to make sure the physical flow of the operation makes sense. I start with my raw materials in a certain part of the warehouse, okay? They call it a storage room, a store room. That's where I have my raw materials, okay? Then I bring them from the storeroom. I put an order to bring them from the storeroom to the manufacturing floor where I have my assembly line. I bring it into what we call work in process. So out of raw materials into work in process. And I have multiple stages in work in process. If I'm making a guitar, for example, I'm going to need raw materials of wood, string, and the facets, right? The brackets, wood, string, and brackets. Those are my raw materials to make a guitar. So I place an order into my storeroom for wood, string, and metal brackets. They then bring it from the storeroom onto the floor, onto the assembly line. It goes from raw materials to work in process. In the work in process, That's when I am cutting the wood to shape the body of the guitar. I am fixing the string onto the neck of the guitar, okay? And then I'll take it from the cutting stage. The next part of the assembly line is going to be the where they glue it together to the neck of the body to the neck to the body of the guitar. And then the next department will be the attaching the strings, and then the next phase will be the putting the brackets together, right? And then it goes from work in process to finished goods. Finished goods means I finished making it and it's available for sale. Okay. But we need to understand the costs associated with that whole process, with all of those steps. We need to understand the cost of the product to control the operations. So it informs me how I need to design my assembly line. And I need to use product costs in order to develop my financial statements. That part's relatively obvious, but because I need to know how much I have in my raw materials, how much I have in my work in process, and how much I have in my finished goods. Those are all categories of inventory on the balance sheet. We also have to know what my direct labor costs are and my factory overhead. And of course, we'll find those items on our income statement. And we'll dive further into that. So what is job order costing? Job order costing system provides product cost for each quantity of product that is manufactured. I want you to think of a spreadsheet, okay? Or I'll show you what a job cost here in a little bit. But think of a spreadsheet. We have our quantity on the far left column. The next column is going to be a description of what it is, right? Okay, so let's say somebody ordered 10 guitars from us. Okay, so I need 10 pieces of wood. I need 10 units of string. I need 10 units of brackets, okay? And then I have the description of what it is in the next column. And then the column after that is how much does each single unit cost. And then on the far right, I have the total cost for each unit, right? And so that's the basics of a job order cost sheet. We'll talk more about that. These systems are used by companies that manufacture custom products for customers or batches of similar products. So most companies that use a job order cost system, they are manufacturers that do batches of products, okay? Usually a guitar manufacturer, they'll make multiple guitars in a batch, yeah? Another example of a job order cost company might be, let's see, an apparel manufacturer like Nike. Another one would be, let me think here. A couple of auto manufacturers use this concept. Tesla, I know does. Toyota, Honda, those companies use the job order cost system. General Motors, I'm not too sure. I think they're probably more process cost system because they're very continuous in their process. So we talked, so that's job order cost. Process cost, as we talked about earlier, something that's continuous, very, very continuous. Process cost systems are used by manufacturers that manufacture continually. An example would be an ice cream company that manufactures ice cream. It's continuous. Oil refinery, paper producer, chemical processors, food processors like Tyson, Purdue. All of these are examples of process cost system manufacturers, right? It's very continuous. It's nonstop. And it goes from department to department to department, and then finished goods, and it goes on a truck, and it's somewhere, right? Another example would be like Coca-Cola, Pepsi, all of the water companies. They all utilize the process cost system in their manufacturing because it's continuous. It's regardless of a single order. They don't care about a single order from a customer. They're going to keep making it because they know they're going to keep using it and keep selling it, right? So looking at our guitar company, our guitar company, so I'll get it right eventually. We use wood, string, and the facets, right? Those are our raw materials. You see here at the top left, we have materials. These are what we call direct materials. We call them direct materials because they make up the majority of the cost of a guitar, right? Direct materials, they make up the majority cost. Direct materials are also called prime costs. Prime costs. Prime costs are the costs that make up the majority of a finished product. These include direct materials and direct labor. Direct labor, as you probably recall, come from the people that are actually on the manufacturing line. They're the ones making the actual product. So they would be the people on the assembly line that actually physically touch the product. So that's your direct labor in manufacturing. You also have indirect labor, which would be people like supervisors and the people in the office. Indirect labor actually gets classified as factory overhead because they do not physically interact with the manufacturing process. We'll talk more about that here in a second. So direct materials, we take it, that's in your storeroom. It comes out of direct materials that goes into work in process. And the work in process, again, they're cutting, they're doing the assembly, all that great stuff. We call that work in process because they're actually working on it at that time. That's both of those stages in work in process are called direct labor. Direct labor, again, because they're physically touching the product. Direct labor is both. Now, here's where it gets a little unique. Direct labor can be classified as both a prime cost and a conversion cost. A conversion cost is we're converting it. Here's how I want you to think about it. It's the process of converting the raw materials to finished good. Converting. It's the cost associated with converting the product from raw materials to a finished good. And in conversion costs, we also have factory overhead, which factory overhead includes things like depreciation of the factory, glue, sandpaper, utilities, supervisor salaries, office salaries, rent, all of the things associated with running a factory, right? That's factory overhead. And factory overhead is a part of conversion cost because we need the factory in order to make the finished good, but we cannot directly trace those costs to each finished good. That's why we call it factory overhead. And we also have finished goods. Finished goods include direct material, direct labor, factory overhead. Those are all of the product costs. We're good so far? Any questions so far?
Yes, we do, sir.
Thank you. Thank you so much. Okay. Let's talk about the job order cost system for our business. The cost system records and summarizes the manufacturing cost by job. So by job. So remember the word job. A job is an order from a customer. A job is an order from a customer. Okay. And the job order cost system tracks the costs while it is in the work in process stage, and while it's in the work in process stage, we track the direct labor and the factory overhead and the raw materials costs while it's being processed, right? We also track the cost while while it's completed and becomes part of the finished goods inventory. Remember, finished goods means we've assembled the guitar and it's ready to be sold. That's finished goods. And when the finished goods are sold to the customers, we take it out of finished goods inventory and it goes to the income statement as cost of goods sold. Cost of goods sold is the term that we use to describe the total cost of the finished good that we sold. That's why we call it cost of goods sold. So for example, let's say a finished good for a guitar costs $80 to make it into a finished good. That includes the direct material, direct labor, factory overhead. All of that together costs $80 to manufacture a guitar. Let's say we sell that guitar for $100. Okay, that's not a very good profit, by the way, but just an example. So when we sell that guitar, we take it out of our finished goods inventory, and from there it goes to the income statement. Of course, there's a couple journal entries that need to happen. So we sold it. So we would debit our cash for $100. We credit sales for $100. That's the first entry. The second entry that needs to happen at the same time is we debit cost of goods sold for $80. And we debit cost of goods sold for $80 and we credit finished goods $80 or finished inventory. Yeah, finished goods inventory for $80. What that does is that second transaction takes it out of the finished goods inventory and gets it onto the income statement. And we'll talk more about that. So the physical flow. Go ahead, Britt.
I was going to say I'm visual, and I just wanted you to explain the two-part process one more time.
Yeah, oh, sure, absolutely. So the first when we sell a finished good, when we sell a finished product, there are two transactions that happens. One is we're collecting our cash from our customer. Okay, so we debit cash to increase cash, and we credit our sales to represent that we sold a product. That's the first transaction that happens. The second transaction that happens is we need to take that product out of our finished goods inventory because we sold it. We no longer have it on hand, right? So, and to do that, what we do is we debit cost of goods sold for the amount that it took us to create that finished good, right? And we credit our finished goods inventory. And what that second transaction does is it takes it out of inventory and puts it onto the balance sheet. Or I'm sorry, onto the income statement. Does it make sense? Right?
Yes, it's just I was visual, so trying to hear it in my head and then try to write it down.
Got you. No problem. And we'll see a few more examples in the coming slides. So think about the physical flow of manufacturing. We have our storeroom, our raw material storeroom. That's where our wood, our facets, our string lives. We take it out of when we get a job in, order, which is an order from a customer, a job. We get the job, so we take the raw materials out of the storeroom. We put it in the work in process. That's when we start putting it together. the guitar. You see here on the slides, we have 4 jobs that are currently in process. These are 4 individual. You see these job numbers right at the bottom of the second and third steps. These job orders represent an order from a customer. Okay, and it shows where it is in the process. So out of raw materials goes into work in process. This is where we add direct labor and factory overhead in addition to our direct materials, right? So there's 2 jobs. It shows where they are in the process. This first person's working on job number 72. This second person is working on job number 71. When they eventually, when these 2 employees finish putting together the guitar in the assembly process, they'll transfer them to finished goods, and eventually it'll make it to the customer. The customer in this case, a couple of different music stores. We already have a couple of jobs that we finished that are sitting in the warehouse waiting for transport to our customers. This is kind of a nice visual representation of the physical flow of the manufacturing process and the related costs. The job order cost system for the manufacturing business, the way I want you to think about this is we use what we call perpetual inventory for controlling accounts. Perpetual inventory, it's perpetual means continuous, okay? That's what the word perpetual means. Perpetual means continuous. Think of a propeller on an airplane. It's continuous motion, okay? Perpetual inventory means that we control our inventory at every step of the process. Think of a barcode scanner. When you go to a store and you get ready to cash out or check out, the store employee will scan the barcode on the thing that you're purchasing. When that barcode gets scanned, the computer is automatically taking that inventory out of inventory and putting it into cost of goods sold. It's automatic when that barcode hits, when the barcode reader hits the barcode. And so that is perpetual. It's continuous, right? It is automatically deducting things from inventory as things happen. In the manufacturing process, I'll scan the barcodes that are of the raw materials that are in the storeroom and to put them into work in process. In the work in process, I'll scan them again to take them out of work in process and to put them in finished goods. Then when I sell the inventory, I'll scan it again and it goes from finished goods to cost of goods sold. That's the process. That's why we use perpetual inventory, because it's continuous and it helps to update the ledgers in real time. So here's a nice visual representation of the ledgers. The ledgers. Remember, a ledger is an account. It's the name of an account, and we track that account in progress, right? So for the first ledger, we have materials inventory. That's the name of the ledger. Materials inventory includes the individual items. Hickory, oak, maple, these are types of wood, right? That for a body of a guitar, for example. We use materials inventory ledger to track the incoming and outgoing raw materials into our storeroom. We also have a work in process inventory ledger. This ledger tracks the jobs in progress. And then we also have a finished goods inventory ledger. This tracks what we have in finished goods as it relates to those jobs. Let's talk about the materials ledger first. Materials ledger is a controlling account for raw materials in the business. Raw materials, work in process, and finished goods, these are all inventory accounts, okay? Inventory ledgers, if you will. these inventory ledgers to, just like with any other asset account on the balance sheet, to increase an asset account, we debit it. To decrease an asset account, we credit it. So to represent an increase in our storeroom, we debit those materials. To decrease the inventory in our storeroom and to move it to the next stage, we credit it. Make sense so far? Hopefully. Okay, good. Flow charts. Oh, flow charts. Sometimes they're fun, sometimes they're not. This one's okay. Okay. Here's how it looks. Our company, our guitar company, we have to keep ordering wood, metal facets, and string from our vendors, right? Otherwise, our company's going to have some trouble if we don't have enough supply. So we go to our supplier and we say, "Hey, listen, I need to order $10,500 worth of wood, of maple wood specifically for this particular job, because this customer wants a bunch of guitars made out of maple." Okay, great. So we place the order, and we receive our order. We write down the quantity, the amount. You see that here. That's part A, right? And so it hangs out in our storeroom until I need it, right? And I'm not going to use all 750 pieces at once for one job. I mean, sometimes maybe, but usually you have more supply than what you actually need. So I get an order in from a customer, and the customer wants 200 units. So, okay, great. So I fill what's called a materials requisition form out. And this tells the storeroom, hey, I need 200 units for this job. I need 400 units for this job, 500 units for this job. Okay, great. So I send those materials requisition forms to the storeroom. The storeroom then fills those orders for the work in process. So the work in process people fill this requisition form out. It goes to the storeroom. Storeroom fills the order. And you can see that we track the amount based off of the cost. So if I first ordered 750 units from our supplier, it cost 10,500. I can figure out the exact cost of each unit, right? And so I need 200 units to fill this particular job. 200 units, it cost me $2,000 for 200 units. So I take that 2,000 and I put that onto my requisition form. Now, of course, there's going to be some additional cost associated with that process, and I'll show you what that looks like here in a little bit. But we know that when it gets into work in process, there's going to be some direct labor and factory overhead that gets applied to it. So you come down here to this, I'll call this B continued, I guess. We have direct materials, direct labor, factory overhead. We don't know our direct materials 2,000. There'll be some direct labor and factory overhead that'll get tied onto that job sheet. And you can see, based off of this example, how the job cost sheet, it adds up as it goes through the process, right? Just kind of shows you the physical flow, and it also shows you how direct materials, direct labor, factory overhead, that all gets added up on each job sheet. And what the job sheet tells us is how much the finished good cost, and so therefore I know how much to charge my customer. And for those of you who are interested in starting your own business or already have started your own business, and you sell products, it's good to know how much those products cost, because you need to know how to accurately price them. And so using a job order cost sheet, especially if you're the one making the product, it's very good to do that process, because it will help you ultimately to better price your products. Just a little side note. Okay, so with materials, when I receive, and we saw this in step A, yeah. When I receive my materials from my vendor, my raw materials, when I receive it from my vendor, I have what's called a receiving report. It tells me the exact quantity that I received, the condition it was received in, and the cost of the raw materials, and I enter all of that information into my database. So here's how it looks, and here's an example of it. So we received our invoice from our supplier. We enter it into our database through, of course, a journal entry. I debit my raw materials account, in this case, 10,500, and I credit accounts payable, 10,500. The reason why I credit accounts payable is because I just received the bill. I haven't paid them yet. So I credit accounts payable, 10,500. You guys remember that from accounting 220, hopefully. In the storeroom, that's where I store my raw materials. And when I need to utilize those raw materials on the shop floor, I fill out what's called a materials requisition form. And this helps me to track the cost for each job. Now, the costs for each job are filled out on this thing called a job cost sheet. And what this does is it helps me to track the cost for each job as it relates to the materials used, so direct materials, direct labor, the cost of the labor for each job, and the factory overhead. That's the portion of factory overhead that gets applied to each job. So let's break it down. So the summary of the materials requisitions, we do that based off of journal entries, as you might expect. The journal entry for this process to take the raw materials out of raw materials and put it into work in process is we debit work in process and we credit our raw materials. In this case, in this example, it's 13,000. So that's materials. What about labor? Labor, as you know, it's very important to track the expense of labor. In a manufacturing setting, we do that based off of what we call time tickets. Time tickets. It's a little bit different than your standard punch card, or we used to call it punch cards back in the 80s, right? A time card, when you punch a clock, right? Or you scan your badge, you scan in and out, punch in and out. There's so many different terms for it. So an employee reports for work, right? And so most of the time they're hourly employees. And so we need to track the hours the employees have worked on each job. And so to do that, we use these things called time tickets or time reports. And what this does is it records the amount of time that each employee worked on a specific job. Okay. Now remember, a job is a customer order. So keep that in mind. Okay, so here's an example. We have job number 71 and job number 72. And job number 71, we have a couple of different employees. As you can see, looks like we got 5 employees that worked on that job. And we have their time tickets. And it tells me when they punched in, when they punched out, when they punched in, when they punched out, and the exact number of hours worked that an employee worked on that job. And I have the employee's hourly rate. And so as you can see, for example, this particular employee, the total hours worked was 6 hours. At a $10 an hour hourly rate, it means we have a total cost for that job of $60 for labor. That's job number 71. On job number 72, I got another employee who was in the assembly department. They worked a total of uh, 8 hours on this particular job. Their hourly rate is $15 an hour. So that gives us a total labor direct labor cost of $120 for that employee. And so what we do is we take the total labor costs of all hours worked times the hourly rates, and we apply that total labor cost to our job sheet. So just below direct materials. So, and we do that for each job. It makes sense, right? You're still with me? Okay. Just remember, if you have any questions, just feel free to unmute your mic and ask your question. Okay, so that's labor. The summary of all of the time tickets for that job or for the end of the month, we have to make a journal entry, as you might expect. So what we do is we debit work in process, because remember, the direct labor is a part of work in process. Those are the employees actually doing the work for each job. So we debit work in process to increase work in process, and we credit wages payable to increase wages payable. Wages payable, by the way, that's a liability. To increase a liability, you credit it. Just keep that in mind. And so in this example, it's 11,000. So that's labor. Now, of course, we got to talk about factory overhead. Factory overhead, as you know, includes all the manufacturing costs except for direct materials and direct labor, because we can directly trace direct materials and direct labor. For things that we cannot directly trace to each individual job, we classify that as factory overhead. In this case, we have things like indirect materials. Indirect materials are small things like glue, parts of the facets, I don't know, stickers, right? Lacquered. Lacquered is a product that you put on the wood to make it shiny, right? Or stain for the wood. Those are things you put on the guitar body to make it nice and shiny. But those are indirect materials. The reality is you really can't trace the small increments of glue or lacquered to each job. It's almost impossible, right? So we call it indirect materials. Indirect labor. These will be supervisors' salaries, wages of the janitor that cleans the shop floor, that type of stuff, indirect labor. Then we have other factory overhead like utilities, and the utilities that power the machines, right? For the saws and the shaping the wood, things like that. And we have factory depreciation. Depreciation for the factory would include the building itself, and it would also include the machinery, because the machinery will, of course, depreciate as well. So that's factory overhead. So how do we allocate the factory overhead, you might ask? Well, there's a couple of different methods to allocate the factory overhead. Go ahead, Britt.
I have a question, and it's not a major question, but the question is on the previous slide, and it just confuses me a little bit.
Sure.
Yeah, so this is the one that gets me. The factory power that comes from utility bills, but isn't factory power what it's requiring to power the machines, and isn't that measurable?
Yeah, so it can be. Yeah, so typically, and very good point, Britt. So typically what happens is most manufacturers, especially smaller ones, they probably aren't going to use power readers for each machine to track the actual wattage that they're using throughout the day. They'll just simply take the utility bill and then, divide it across each job to figure out the overhead for electric. They probably won't go to the trouble of putting up a meter reader for each machine. Although you could. So to answer your question, it's still factory overhead either way because it's a utility. But you could trace it to each job if you were just using that one machine for that one job and you track the wattage. You could, but in most cases, I'd say like 95% of the time, companies don't go that far. They're not going to put a meter reader up to each machine and actually measure out the wattage output for each machine. It's a good question though, but typically what they'll do is they'll take the whole bill and divide it across. Does that make sense, Britt?
It does. When you said generally because it's a utility, it gotcha.
Exactly. Yeah. Yeah. A lot of times they're not going to go to that far detail. Good question. So how do we allocate the factory overhead? There's a couple of different methods to do this. Factory overhead, as you know, are things that cannot be directly traced to each job because it becomes difficult to do that in most cases. And again, the factory overhead includes things like utility bills, factory depreciation, machine depreciation, supervisor salaries, indirect materials. So what we do is there's a couple of different methods. One of the methods is you could use straight line and just simply take the factory overhead and divide it by the number of jobs. That's one way of doing it. There's a couple of different ways, and we'll talk about it through this process. So how do we allocate the cost? Cost allocation is a process by which we take factory overhead and allocate it to each job, or we assign a cost object. This we're going to get a little bit into activity-based costing now, but we're going to dive deeper later on next week. Factory overhead costs are allocated to jobs using a common measure. For example, machine hours. Machine hours, the number of hours I'm operating each machine, that's one way of allocating factory overhead. Another method would be, let's say you have a forklift and you're driving the forklift around, that there's hours that are tied to that forklift. That forklifts are measured in hours, not miles. Another example would be, let's say you have a delivery truck. The miles driven on the delivery truck would be an activity base. But we use activity base to measure as an activity driver for a job. So bases would include things like direct labor hours, direct labor cost, and machine hours. There's a couple of different examples for allocating. So it gets a little tricky. We're going to talk more about that next week, but this is in alignment with activity-based costing. So that's what activity-based costing is, one method for applying factory overhead. Another method is to use predetermined factory overhead rate. This is probably a little bit more common because it's easier to be very specific. Predetermined factory overhead rate are applied to each job. This basically tells us the rate. It's a percentage. It gets applied to, we take the factory overhead rate and we multiply it by this percentage to figure out the allocation for each job. How do we do it? We take the estimated total factory overhead cost divided by the estimated activity base. Now, again, the activity base goes back to either direct labor hours, direct labor cost, or machine hours, or another factor that is a basis, right? So in our example, I forgot which one we used, but I think it's labor hours. It's the easiest one. It's the easiest one. But just remember, activity based means what is the primary basis for the job. That's typically how we figure out which base we're going to use for a job. It's the basis for the job. So in our case, it's probably going to be labor hours or labor cost. And then, of course, and then you're probably wondering, well, Dr. B, it says estimate. What does that mean? Estimate is an estimate. It's estimated throughout the year or throughout the month, right? It's the estimate of the total factory overhead cost for that month or for that year, for that accounting period. And then the number of hours that we expect to utilize during that time period as well. So let's look at our example. This is a nice example, by the way. We assume that our company, our Legend, remember, we make guitars, yeah? So we assume that our total factory overhead is going to cost us $50,000 for the year. And we're going to utilize 10,000 direct labor hours. Is the total number of hours that our employees we think are going to work for that year. So to figure out the factory overhead rate, we take the total factory overhead estimate, 50,000, divided by the 10,000 direct labor hours that we expect our employees will work for the year. That gives us $5 per direct labor hour of factory overhead. So $5 per direct labor hour is our predetermined rate. So using activity-based costing, we use the method for accumulating and allocating factory overhead costs. We also use it for different overhead rates to determine factory overhead activities, such as inspecting, moving, and machining. Inspecting, what that word means is we look for quality control. When you do quality control measures, and some of you, especially in the military, know how to identify quality control. What you do is you break down the process, you break down the finished good, and you inspect it for quality, right? So in our guitar example, they'll disassemble a finished good. They'll disassemble a guitar to look for any type of flaws in the manufacturing process. That's quality control. Other examples would be moving and machining. Machining is, operating a machine. So we apply factory overhead to each job, typically using the factory overhead rate in our example. So we said that our factory overhead rate was $5 per labor hour. In job number 71, we had 350 labor hours. We allocate $5 per direct labor hour for factory overhead. And so $5 times 350 hours for the job is 1,750. So 1,750 is our factory overhead for that job. And we do that same process for each job. Now we can see that for job number 71, we finished the job. Okay, we have we completed 20 units. We had a balance of 3,000. Direct materials was an additional 2,000, plus direct labor 3,500, plus factory overhead 1,750, gets to a total job cost of 10,250. So nice example. And we do that same process for every job. What if we have multiple jobs? What we do for each job is we take the direct labor hours, multiply by the factory overhead rate to get us to the factory overhead applied to each respective job. And you add all of your jobs together to get you to your total for that year or for that month or whatever. The journal entry for applying factory overhead. to work in process. We debit work in process to increase our work in process, and we credit factory overhead to increase factory overhead. Factory overhead account is increased for the actual overhead costs, and we decrease it for the applied overhead. The actual and applied overhead usually are different because the actual overhead costs are normally different than the estimated overhead costs. This is typically because we're estimating. Every time we estimate, it's going to be different than the actual. Usually, it's usually always different than the actual. Britt, go ahead.
What is applied overhead?
Applied overhead is the overhead that we actually incurred and we applied it to the job. So going back to this, we are applying overhead to that particular job or to those jobs. And to do that, we debit work in process, credit factory overhead. When we credit factory overhead, we're applying the overhead to those respective jobs. Does that help to answer your question?
Yes.
Wonderful. Great. Thanks for the question. Okay, so remember, we estimate at the beginning of the year. We say, hey, you know what? We're going to use 10,000 labor hours. Our total factory overhead, we estimate, is going to be 50,000. This are estimates. So based off of our estimates, there's either going to be an under application or over application of factory overhead. The difference is because of the estimates, right? So depending on whether we over applied or under applied, we have to make a respective debit or credit to under applied or over applied factory overhead to adjust it to the actual. Yep. And that's done through an adjusting entry. Hopefully you remember adjusting entries from Accounting 220. Hopefully. I know that was probably so long ago for some of you. Okay, we'll skip that one. It's not as important. Disposal of factory overhead balance. During the year, the balance of factory overhead account is carried forward and reported as a debit or a credit on the balance sheet. However, any balance of factory overhead account should be carried over to the next year. You don't really have to know that. It's just, I guess it's good to know. These are the journal entries. Don't worry, you won't be tested on this part. These are the journal entries that we would make for the factory overhead at the end of the year. So we would debit cost of goods sold to increase cost of goods sold, credit factory overhead. This is to transfer the under applied overhead. If it was over applied, we would debit factory overhead and credit cost of goods sold. Just remember, at the end of each year, if I make an estimate at the beginning of the year, at the end of the year, I need to adjust for that estimate. And to adjust for that estimate, I need to use either under applied or over applied factory overhead. That's just an adjusting journal entry at the end of the year. And so in our example, we had under applied factory overhead of $150. So we debit cost of goods sold and we credit factory overhead. Work in process. Work in process, we talked about this. This is where the employees are making the guitars. It's work in process. Work in process will include direct materials, direct labor, and factory overhead. And here is the job cost sheets that we talked about. Throughout the process, each job will have direct material, direct labor, factory overhead. All of those costs get added up to equal the total job cost. And the total job cost gets recorded on the respective ledgers. Nice and easy, right? Finished goods. These are when the goods are available for sale. They went through started from raw materials. They went through a work in process. They became finished goods. Finished goods means they are ready for sale. Yeah. And so the information that's tracked in finished goods are the costs of each unit manufactured. When I sell it, it becomes cost of goods sold. And this information also tells us what we have on hand. And here's an example of the general ledger for finished goods. Nice and simple. So cost of goods sold, of course, throughout the year, hopefully I sell my products. So when I sell my products, I debit accounts receivable if I sold it on account, or I debit cash if I sold it for cash, and I credit my sales. Now remember, every time I make a sale, I need a second entry to reflect the sale of that product. And so what do I do for that? I debit cost of goods sold and I credit finished goods. Make sense? Yes. Britt, does it make sense? This is what we talked. That was your question from earlier. Remember, you said this is a good visual representation of those two journal entries we talked about.
Yes, sir. I'm following along.
Wonderful. Very good. Very good. Okay. We briefly talked about this period costs and what was the other one? Period costs and process costs. Period costs. Period costs are costs incurred during the accounting period as it's related to selling a product. Now, of course, before I sell a product, I need to make the product. So period costs include generating revenue during the current period. They also include costs they're not involved in the manufacturing process. And it also includes the cost of selling the product. So when I sell my product, I'm going to incur selling expenses and administrative expenses. Selling expenses, those are the salaries for your salespeople. Okay, those are selling expenses. It'll probably also include things like advertising. Advertising expenses are also considered selling expenses. Administrative expenses, that would be the cost of your people in your accounting office to send the bill out. It would include things like, it might include shipping. It might call supervisor's salary for the salespeople. Those are administrative expenses. Selling expenses might also include the cost of shipping it to your customer. And it's all for the current period, right? That's why I call it period cost. Selling expenses include marketing and delivery of a finished good to the customer. Administrative expenses might include things that are not related to the manufacturing or selling functions like office supplies, office expenses. So to record these expenses, we debit our sales salaries expenses, we debit our office salaries expenses, and we credit salaries payable. It's just an example of that. What does our income statement look like for a manufacturer or for a retailer? We have sales minus cost of goods sold equals gross profit. Then we have our selling and administrative expenses. So total selling administrative expenses, we take our gross profit minus total selling administrative expenses to get to our operating income. Job order cost systems may also be used by professional service businesses. Remember, professional service business includes things like advertising agency, attorney, a doctor, a lawyer, a dentist, an accountant. These are all service businesses, right? They provide a service, not a product. But you could actually use job order cost systems viewed by the individual client. So, for example, an attorney will have a job cost sheet for their client: number of hours billed, number of hours worked, number of pieces of paper used, so forth and so on. But the primary idea is to track the costs associated with each patient or client or customer. Just interesting stuff. We're not going to dive too deep into that. We're more focused on the manufacturing side of things. Job order cost systems accumulate the records of product cost by job, as we talked about. And here's another example of a job cost sheet that we looked at. We're almost done. Job cost sheets are analyzed for future reasons as well. They help us to control costs by looking at them. Okay, that's the end. Yay. And I'm sorry, we went a few minutes over. My apologies. I know we always get caught on our fun discussions around these topics. Are there any comments, questions, concerns so I can help to answer for job order cost systems that you might have? Anything at all? No, we're good. Okay, any questions about the course so far, about anything? Anything at all? I mean, I'm here. Britt, go ahead.
It doesn't relate to this because I will have to read this again, and then I'll probably put it in the discussion board because I know I'll have to review it to remember what I forgot to ask you. But my question about the course, it's not about the course, it's about the career exploration.
Sure.
Actually, one thing that I really didn't gloss over to see what it was about.
Yeah, so the career exploration assignment, you'll go to Career Quest, you'll look up pretty much like information about related accounting jobs, or the prompt should be pretty specific, but from what I recall, you go to Career Quest, you kind of like look at related accounting jobs, you get ideas, and then you write up a very short couple of paragraphs about what you found. It's more geared toward the idea of helping you to find employment that you're interested in, and what that process entails, things like that. It's pretty straightforward. You don't stress too much about it. It should be pretty easy for you. Good question.
Sounds good. Thank you.
You're welcome. Any other comments, questions, concerns? Are we all good?
Dr. B, I had a quick question about the discussion.
Go ahead, Ryan.
So in the Sec 10K, the balance sheet discussion, it goes over treasury stock, and for the treasury stock, it said that it has a negative equity balance.
Yep, that's right.
I was kind of just confused on that.
Yep. So what is treasury stock is the better question. So treasury stock comes from the fact that companies will repurchase their own stock to increase the value, right? And we see that all the time. We see companies buy back stock from their stockholders. And what happens when the company buys stock back is they oftentimes pay a premium to the stockholder, a premium meaning above market price or above what that stockholder paid for that share of stock. And so what happens is that in turn creates a negative equity on the balance sheet because the company is repurchasing stock from their shareholders to increase the value of the company, which in turn creates a negative equity because on the balance sheet, they'll actually represent the repurchase of that stock. And that's why it's negative. Does that make sense, Ryan?
That makes sense. Thank you, sir.
My pleasure. Absolutely. And not all companies do that. So you might be having a company that you're working on for your 10K project. They might not have treasury stock because they never engaged in the repurchase of shares. But that's a good question. I'm glad that you asked that. Very good. Any other comments, questions, or concerns before we call it a day or evening or morning, wherever you might be? We're good?
No questions, sir. We're good.
Wonderful. Thank you, Ismail. Appreciate it. Okay, wonderful. Well, I'm going to go ahead and stop the recording. Thank you all so much for joining me today. I appreciate your time. I appreciate everything that you all do. Thank you for your service, and thank you for joining me. And if you ever need anything, you just let me know. I'm here for you. I'll respond to your emails. I'll respond to your phone calls. And of course, I'll see you in the discussion forums. Thank you all so much for your time. I appreciate all of you.
Thank you.
Have a wonderful evening. Stay safe. Wash your hands.
Thank you.
You're welcome. Take care, y'all. Good night, or good day.